Information presented is for educational purposes only, and views regarding the economy, securities markets, or other specialized areas, like all predictors of future events, cannot be guaranteed to be accurate. Information does not intend to make an offer, recommendation, or solicitation for the sale or purchase of any securities.
Welcome, everyone. I'm Jason Nickerson, President and Chief Operating Officer at John G. Ullman Associates, and this is Meeting the Market. This monthly series is designed to keep you informed on the economic news, market developments, and trends shaping today's investment landscape. In each episode, we'll break down recent market activity, highlight key events to watch, and discuss what may lie ahead. With nearly 30 years in the financial services industry, my goal with Meeting the Market is simple: to provide clear, timely, and unbiased insights on what matters most, so you can stay informed and confident in a constantly evolving market. So with that, let's meet the market and get started with this month's episode. Let's start with the macro picture, because the backdrop right now is a mix of resilience, uncertainty, and some very real cross currents. We came into March with the economy showing a surprising amount of underlying strength. Productivity growth has been one of the biggest stories. AI adoption, new business formation, and investment in power infrastructure have pushed productivity close to 5% in recent quarters, far above last year's pace. That's been a major driver of the stronger than expected GDP numbers we saw late last year. But the momentum has cooled a bit. Fourth quarter GDP came in soft at about 1.4%, weighed down by falling exports, the government shutdown, and severe weather disruptions. Even so, there doesn't seem to be a call for a recession from forecasters. There seems actually to be an expectation of moderate growth through 2026, though slower than the standout numbers we saw in the third quarter of last year. The Federal Reserve met this month on March 18th, and as expected, they held rates steady, citing the same cross-current rhetoric. Economic activity expanding, job gains remaining low, little change in the unemployment rate, and inflation remaining somewhat elevated above their target level. After 3 consecutive cuts at the end of 2025, the Fed is now in a wait-and-see mode. Energy prices have spiked due to the escalating conflict in the Middle East, and that's complicating the inflation outlook. The Fed wants to see how those pressures filter through before making its next move. Globally, it's a rare moment where the Fed, ECB, the Bank of Japan, and the Bank of England are all meeting in the same week. All are expected to hold rates steady, but the tone from each central bank will matter. Markets are watching closely for any shift in how they're thinking about inflation, growth, and geopolitical risk. And speaking of geopolitics, the conflict involving the US, Israel, and Iran has already pushed crude oil up more than 20% in just a week. That's feeding into inflation expectations and adding volatility across global markets. Despite that, the underlying US economy remains relatively solid. About 87% of GDP has been growing steadily between 2% and 3% for the last couple of years. So the macro story right now is this: solid fundamentals, rising geopolitical risk, and a Fed that's on pause but not done. In summary, return of inflation, even if in just one area, if it does come back, do not expect rates to be lowered. That can certainly have a ripple effect on many areas, including consumer sentiment and the spring real estate season that's upon us. Now let's shift to the corporate side, where several big names are driving headlines and sentiment. Tech and AI-driven companies continue to be the market center of gravity. With productivity gains accelerating, investors are rewarding companies that are enabling automation, data processing, and energy-efficient computing. That's why we're seeing strong flows into both mega-cap tech and, interestingly, mid-cap names that are tied to the AI supply chain. Energy companies are back in the spotlight as crude prices surge. Higher oil prices are boosting revenue expectations for integrated oil majors, but they're also raising concerns about input costs for transportation, manufacturing, and consumer goods companies. Markets are trying to figure out whether this is a short-term spike, the beginning of a more sustained period of elevated prices. Financials are navigating a tricky environment as well. With the Fed on hold, net interest margins are stabilizing, but loan demand is softening. The bigger story is credit quality. Still healthy, but investors are watching for any cracks if energy prices stay elevated or if geopolitical tensions worsen. Consumer-facing companies are sending mixed signals. On one hand, wage growth and employment stability are supporting spending, On the other hand, higher energy costs and lingering inflation pressures are squeezing discretionary budgets. Earnings calls this quarter have all been about pricing power, who still has it and who's losing it. And finally, industrials and small caps are seeing renewed interest. Investors are rotating into these areas with more attractive valuations and better growth potential after the mega cap rally of the last 2 years. That rotation is still early, but it's gaining momentum. So across the board, the theme is companies with pricing power, exposure to AI productivity gains, or leverage to higher energy prices are outperforming. Companies sensitive to input costs or global supply chains are facing more headwinds. Now let's take a look ahead to the next 30 days or so. There are three major things we're watching. First, the Fed's tone, not just the decision, but the language around inflation, energy prices, and the path of rate cuts. The dot plot will give us a clearer picture of where the Fed expects rates to be by the end of 2026. Second, geopolitical developments. The Middle East remains the biggest wild card. If tensions escalate, we could see another leg higher in oil prices, which would ripple through inflation expectations, consumer sentiment, and corporate margins. Markets are extremely sensitive to headlines right now. And then third, earnings guidance. We're past the bulk of earnings season, but the guidance we're hearing from CEOs is crucial and will continue to be. Are they talking about expansion, hiring, and demand, or are they signaling caution? Guidance tends to lead the economic data by several months, so it's one of the best forward-looking indicators we have. I'm also keeping an eye on flows into mid and small cap equities. If that rotation continues, it could signal a broadening of market leadership, something we haven't seen in a while. So the next month is all about policy signals, geopolitical stability, and corporate visibility. Now, how does all of this apply to you? I guess first and foremost, I'd say don't overreact to headlines. Markets move fast, but our long-term plans shouldn't. You should be reviewing your cash strategy as yields are still fairly attractive, but they will fall when rate cuts begin. Also, consider rebalancing. After the last 2 years of strong equity performance, many portfolios are overweight stocks without people even realizing it. The theme right now is positioning, not predicting. You can't control the headlines, but you can control your emotions, allocation, your risk exposure, and your discipline. We tell our clients that if they are nervous about everything going on, then they should take an action to pull their portfolio risk back. However, I don't want viewers to take the other direction and try to catch the next big move by going all in on what they think will be the bottom of a pullback in the market. This is where revisiting your long-term plan and staying disciplined are key. And with that, that's this month's Meeting the Market. We'll see you next month.
Thanks for watching. If you found this video helpful, give it a thumbs up and hit that subscribe button so you don't miss future updates. Looking for more insights like this? Head over to our website at jgua.com for additional resources. And if you'd like to talk about your personal financial goals, we'd love to help. Just click the Schedule a Meeting button highlighted on your screen to book your complimentary consultation. Thanks again for joining us. We'll see you in the next video.